We own a Greek cement company. But before I get into the details of what we own is, think of what we're trying to do. We want to buy businesses cheaply that are going to be around for a while. So going back to the discussion about business models, about not needing recurrent financing, you make the first important assumption is the capital markets are going to close down. You, company in Greece or company in Italy or company in Spain, are not going to have access because your bank's a bust. And nobody wants to write a check for a Spanish company or Italian company. So you should have the ability to survive on your own, okay? For a reasonable period of time, give it a year, 2 years, without having recourse to external financing. Because otherwise, you might be in this position that if you don't get your bank financing in place, you might have to engage in terribly dilutive equity financing, for example, because there's always somebody willing to write a check at a price. And if I'm your investor, I don't want to terribly dilutive financing to reduce the value of my holdings. So you've got to be able to survive the near term, assuming the closure of capital markets or source of external finance. The second thing, which is very peculiar to the situation. Now, everybody threatens to throw everybody else out of the euro. So Germany's going to throw Greece out, Germany's going to throw Italy out and Spain out. I mean, there's sort of this angst-ridden drama that's unfolding. So, I said, fine. We saw Argentina unpeg itself. So we can assume the drachma unpeg itself from the euro, or the peseta unpeg itself, or the lira unpeg itself. And yes, you will have this new currency. So you ask the question, now suppose the drachma would come back. Would our Greek cement company survive? Well, it was an obvious question for us to ask. Would we bought our Italian investor, Parmalat, would Parmalat survive if the lira came back? And the short answer was, of course it would. Well, Parmalat had two issues. It had 1.6 billion euros of cash and was making money around the world, excess cash. So capital markets are not an issue. Second, Parmalat was, yes, it was listed in Milan, traded in Italy. It was an Italian company nominally, but the Canadian business was bigger than the Italian business, the Australian business was bigger than the Italian business, and did stuff in the rest of the world. So Italy was a part of its business, but it was not a deal killer for us. So that's how Parmalat made sense to us. So what about a cement company in Greece? Well, we own the cement company in Greece because it is listed in Greece, but does a lot more outside Greece than it does inside Greece. And I suppose it could be a comforting fact at some point in the future, like it had been in years past, that Greece is a duopoly. It's a duopoly which has always been oversupplied with cement, and most of the cement is exported. Because cement is exported, the reintroduction of a drachma, I suppose, is probably good for that company. But this company also has operations in Turkey, in Egypt, in many of the Balkan countries. It also is a reasonable sized player in southern Atlantic states in the United States. It's actually quite big in Florida. It's a big player in Florida. And maybe the Florida market will revive before the Greek market. Who knows? And it doesn't need financing. So, I mean, that's how we own that. Now, the problem with buying in these markets, mechanically you can see cheapness. The problem is, how did the banks and how did everybody get so crazy in leverage? Well, the banks lent a lot. So companies borrowed a lot. And witness the stuff that's been going on. A lot of these companies in Spain went out and acquired stuff in Latin America. Witness Repsol's newest adventures, Repsol's adventures in Argentina, for example. Repsol's busy. I mean, Spanish companies have to look, oil companies have to look outside Spain for oil and oil resources. And they did, legitimately and reasonably. But so, of course, they went outside Spain. So finding companies that are cheap, meet our criteria in terms of, obviously, in terms of safety from a capital markets perspective, from a perspective of governance, and that's quite important. Most of these companies are controlled, and sometimes by highly leveraged owners above. So, of course, the temptation is to do stuff which may or may not be good for you. For example, you can talk about Endesa. Endesa, a big Spanish utility. Now, the problem is, sitting on top of it is Enel, which owns 92% of Endesa. Enel is a highly leveraged Italian utility. So, we know who's going to finance whom. So, that's the sort of problem you've got to worry about. What are the owners like? What are their motivations? Will they strip cash out of you and leave you with nothing?